Hello students, welcome to BYJU'S IAS. In today's live discussion, we will be having a discussion on economy this week, which will be covering the time period from 13th to 19th of February 2021. And in this particular live discussion, we will be taking up certain very important articles which have appeared in various business related newspapers, and we will be analyzing these particular articles. For this particular discussion, I have taken the articles from newspapers such as Hindu, Indian Express, Live Mint, Financial Express, Business Line, etc. Let's start the discussion. The first article is related to a concept of operation twist. Now, before looking at what factual information has been provided in the article, what is this idea of an operation twist? And please understand, very often this particular terminology has been mentioned in the newspaper, and there is a very high expectation of questions on this kind of a concept, especially of the ideas which are conducted by RBI. Now, what is this idea of the operation twist? Now, understand this, in case of the economy, or let us say the market, RBI basically auctions, I am using the term auctions here, RBI auctions as well as repurchases the government securities. Is it okay? Government of India, in order to meet certain expenditure requirements, that is basically given in the budget estimates, will sell these particular G securities, which are nothing but the debt instruments issued by government, and collects a certain amount from the market. Now, generally the auctioning process of these particular G securities and the repurchasing of these particular G securities is done by Reserve Bank of India. It uses a platform which we have already mentioned in the earlier videos, e-Kuber platform. Remember the name. E-Kuber platform is used by RBI to auction these particular G securities to market participants and collect the money and transfer it to government. Now, generally what we say is either RBI sells the G securities or repurchases the G securities, and whenever any one of the two functions is done, we use the term open market operation. OMO stands for open market operation, under which either RBI will sell or repurchase the G securities as per the requirement. For example, if RBI wants to promote growth, in order to promote growth, RBI needs to push higher liquidity in the market, and one of the ways of pushing higher liquidity in the market is purchase or repurchase the G securities which are present in the market and supply the money to the investor. And on the other hand, if RBI, let us say, wants to control inflation, in that particular scenario, RBI will go on using many tools. One of the tools is sell these particular G securities, suck out the liquidity from the market. Now, in the present situation, what is the idea of an operation twist? Have a look at this. Under operation twist, RBI simultaneously, you will have to remember the term simultaneously, RBI simultaneously will sell some types of G securities as well as purchase some types of G securities. Now, what kind of G securities are sold and bought under operation twist? Under operation twist, RBI sells short term G securities and repurchases or buys the long term G securities. Now, why this is done? Have a look at this very carefully. In case of the market, there is a technical term called as coupon rate and yield rate related to these kind of debt instruments. Do not get confused between both of them. Coupon rate generally means interest rate, and it simply specifies or it simply represents what is the rate of interest provided on certain instrument. For example, if I issue a bond to you, let us say worth 100 rupees, and if I offer to you 8% rate of interest, this becomes coupon rate on this particular bond or a debt instrument. But yield rate specifically refers to how much is your actual earning. Is it okay? How much rate of interest you have actually earned on this instrument is the concept of a yield rate. Now, what is the basic difference here? The basic difference is, have a look at this. I have sold the bond to you at 100 rupees, and let us say you will hold on to this for a period of 1 year, and I will pay 8% rate of interest. So, coupon rate was 8%, and how much you have earned? 8%. But what if you sell this particular bond to your friend at 97 rupees, just a hypothetical number. You sell the bond to your friend at 97 rupees. For this particular third person, that is your friend who has bought this particular bond, his investment is how much? 97. But he will earn interest of how much? 8 rupees. So on the investment of 97, he is earning 8 rupees. So don't you think his interest rate earning will be much higher than 8%. So have a look at this. In this situation, though coupon rate is 8%, yield rate will be more than 8%. So in simple terms, have a look at this relation in the market. Just remember this particular correlation. Whenever the market prices of the bonds will increase, whenever the market prices of the bonds will increase, yield rates will come down. Opposite. Whenever the market prices will increase, yield rates will come down, and when market prices will fall down or come down, yield rates will increase. That is the basic correlation here. Now, why you should understand this particular correlation and what is the importance in the Indian economic context? Whenever, if I say Government of India is issuing the bonds, for example, in this particular article, it says Government of India wants to issue bonds to the tune of more than 30,000 crore rupees. And out of this, right now, RBI is basically going for operation twist for more than 10,000 crore rupees. Again, not required for UPSC. What you need to understand simply is this: when Government of India will issue these particular bonds, can I simply say that if the yield rates in the market are lesser, then Government of India can issue these particular bonds and raise money by promising lesser rate of interest. Is it okay? If yield rates in the market are lesser, then the RBI can issue the bonds, that is the G securities of Government of India, and collect the money by offering lower coupon rate, lower rate of interest. In simple terms, whenever yield rates in the market will come down, interest rates in the market will come down. This will help in Government of India's revenue collection or raising of revenue, because large amount of expenditure that is incurred, it is budgeted by borrowings from the market, and one of the very important source of borrowing for Government of India is to issue G securities. So have a look at this. Whenever Government of India wants to issue the bonds, obviously it wants lesser yield rates in the market, and whenever RBI conducts this kind of a operation twist, it is expected that the yield rates will come down. Now you will simply ask, sir, how operation twist is connected with the yield rates? Let me give a very simple example here. What generally RBI does, generally under open market operation, like we have discussed, either sell or repurchase the G securities. But under operation twist, RBI simultaneously sells short-term G securities and purchases the long-term G securities. Now have a look at this. The basic economics says whenever the supply of some commodity increases, the market price should start coming down. Is it okay? When supply increases, market prices should automatically start coming down. When demand for certain commodity increases, market prices should increase. So when I say RBI will purchase a long-term G securities, obviously the demand for these particular G securities in the market will increase. When demand increases, what do you think will happen to market prices? Market prices should start increasing. And when market prices increases, what do you think will happen to the yield rate on these particular G securities? Yield rates should start coming down. And generally understand this, in case of the economy, whenever the lending rates are decided, one of the very important factors that will affect these lending rates or interest rates in the market is the yield rates on the long-term G securities. For example, 10-year tenure G securities which are issued by the government. So that is a very important concept related to operation twist. Now what information has been provided in the article? RBI will be conducting operation twist worth 10,000 crore rupees on February 25th. And basically under this, it will be purchasing securities which are maturing on or in 2025, 2029 and 2033. So these are long-term bonds which RBI will be purchasing, and on the other hand, it will be selling short-term G securities. Obviously short-term means which will have a maturity period of up to 1 year. So these particular instruments which will be sold by RBI with a short-term tenure will have maturity in the month of November as well as in the month of February 2022. So these are certain very important points related to concept of a operation twist. Now based on this, I have given a question here. Consider the following statements. Under operation twist, RBI sells long-term G securities. I have not written G securities, but read it as G securities, and purchases a short-term G securities. Exactly vice versa. So this particular statement is wrong. With operation twist, the yield rates on the long-term bonds are expected to come down. Yes, this particular statement is true. So right option is option B, only 2 is true. Next, another article related to RBI bonds itself, or government bonds which are being issued by RBI. Very short amount of information should be taken from this particular article. Now please understand, government bonds, or let's say government securities, are of two types. One with maturity up to 1 year, and second maturity more than 1 year. Is it okay? Understand this concept very, very carefully. I am giving you certain basics here. Now, whenever these particular G securities have maturity period of up to 1 year, these are called as treasury bills, and whenever the maturity period is more than 1 year, these are referred to as the dated securities. Now, treasury bills are generally issued at discount and redeemed at par value or face value. What is the meaning of this? Imagine the value of a treasury bill is 100 rupees. When RBI auctions these particular treasury bills, these are not auctioned or sold at 100, rather these are sold at lesser than 100 rupees. These are sold at a discounted value. And once the maturity period is over, these are redeemed. That is, the money that is paid to the investor in the bonds is the face value of this particular bond. So this is a feature related to treasury bills. Look at the other hand. Generally, when I say more than 1 year, the government of India issues bonds with the maturity period of either 5 years or up to 40 years, right? So between 5 years to 40 years, these are generally the tenures of the dated securities which are issued by government of India. And what is the importance of these particular types of dated securities? Imagine here is the government of India. Imagine the situation. It wants to collect, let's say, 10,000 crore rupees by issuing G securities. Now, what do you think is a better situation? Should it issue the bonds, or let's say, should it issue the G securities with a maturity period of up to 1 year, or should it issue dated security with a maturity period of, let's say, 40 years? Look at the present situation. Again, looking at the present situation, longer the tenure, better the position for government of India. For a simple reason, presently the finances of government of India are under lot of stress. So if government of India collects a lot of money, let's say 10,000 crore rupees, just a hypothetical number, by issuing G security which will have maturity period of, let's say, 91 days, that is specifically the concept of a treasury bill, then within 91 days, or let's say at the end of 3-month time period, it has to repay this particular 10,000 crore rupees. So don't you think in the present situation, it is better for government of India to raise money by issuing long-term bonds? And that is exactly what is being done here. Basically, there is a bond with a maturity period of 40 years. This is the highest tenure of G securities or dated securities which are issued by government of India. For the first time, such a tenure or such bonds with a very high amount of a tenure were issued in the year 2015. And again in the year 2019, these types of bonds with a maturity period of 40 years, again these were issued. Again in 2020, these were issued to raise more than 2 lakh crore rupees for government of India. Now, RBI basically says it will be issuing another round of 40-year bonds, right? That is the most information that you need to take from this particular article. Now, associated with this concept, whenever RBI will issue these particular bonds with higher maturity, it also means that in the future, let's say after 40 years, there is a huge repayment liability for government of India. So, you will have to keep this particular point in mind. Yes, the tenure or the maturity period is very, very high. That does not mean that after 40 years there is no repayment liability. It generally means after 40 years, a huge amount of repayment liability will be on the shoulders of government of India. So these are certain points related to concept of 40-year bonds proposal of RBI. Now related to this, I have given a question here. Consider the following statements. The highest tenure of dated securities issued by central government is 40 years. Definitely correct. The interest on the dated securities is paid half yearly. This is a technical point as such. Understand this, whether it is the dated security of a maturity period 5 years, 40 years, does not matter. Whenever the interest rate has to be paid on these particular dated securities, it is paid half yearly. Remember this particular term. The statement is true. So, it is a technical information, but remember this. Interest on these particular dated securities is paid half yearly. The statement is correct. So, right option is option C. Both 1 and 2 are correct. Next article, inflation. Now, please be very, very careful. I will be discussing certain very important concepts here. For the month of June to November, the inflation rate averaged more than 6%. First point. Okay. And why this is very important? RBI under the Monetary Policy Framework Agreement, MPFA, or commonly referred to as a concept of inflation targeting, has to maintain inflation rate at 4% plus or minus 200 basis points, which essentially means RBI cannot allow the inflation rate to cross more than 6%, cannot allow the inflation rate to fall below 2%. But for the month of June to November, the inflation rate averaged more than 6%. That was a cause of concern for the Monetary Policy Committee. Come the month of December. For the month of December, this particular retail inflation, and whenever I use the term retail inflation, it simply means wholesale CPI. Okay. So, retail inflation for the month of December actually climbed down to 4.5%. And for the month of January, which is the latest data which is available, the inflation rate further has come down to 4.06%. I am just rounding off the number, do not worry, 4.06%. So, this should be a very important relief for the policymakers in India. Yes, to a certain extent, yes, inflation rate coming down, especially in the present situation, is a point of relief for the policymakers, especially for the Monetary Policy Committee. Why? The Monetary Policy Committee again and again, especially in the recently concluded review as such, has pointed out that the retail inflation rate is at a higher level, so we are holding the interest rates. And looking at the present situation of Indian economy, there is a need to promote growth, in simple terms, to promote liquidity in the market. But RBI is shackled because of this particular higher retail inflation rate. So, when it has come down to, let us say, around 4%, it should be cause for a relief for the policy makers. However, there are certain concerns even related to this particular inflation rate. Let us go beyond what is given in the article. Understand this. There is a concept called as a base effect. There is a concept called as a base effect. And one of the reasons why the retail inflation has come down for the month of December as well as January is the base effect. Now, what do you mean by base effect? Whenever these particular inflation rates are given for a period of a month like this, for example, here the inflation rate for January has been provided. On what basis this is calculated? Generally what they do is, they will take the commodity prices, that is basket of commodities, what is the price of this particular basket of commodities for the month of January 2020, and they will make a comparison of those particular commodities, same basket of commodities, and what is their price in January 2021. Is it okay? Same month for 2 consecutive years. So, I am comparing the prices of the basket of commodities for January 2021 with the prices of same basket of commodities for January 2020. And whenever the price is higher, basically it is the inflation rate for that particular month in the current year. So, if understand this, if for January 2020 the prices of basket of commodities were very, very low, is it okay? Were normally lower, right? So, normal is, let us say, hypothetical idea here. Normally, let us say for a basket of commodities, the prices would be somewhere in the range of 190 rupees. I am just taking a hypothetical number. Normally, the prices would be somewhere in the range of 190 rupees. But in the January 2020, what if the prices were lesser than the normal prices? And when the level, when the base itself is lesser like this, don't you think it will have an impact on the data for which month we are calculating this year? That is, we are calculating the data for January 2021. When the base itself is abnormal, don't you think it will have an impact on the data for January 2021? That is a basic idea for base effect. To put in simple terms, when I take January data for the current year, compare that with the previous year, what if the price levels in the previous year were abnormally lower? That will definitely have an impact on the calculation for the January 2021. This is called as a base effect. So, understand this, for the month of December, The inflation rate has come down. One of the reason, again I am saying one of the reason is said to be base effect. And for the month of January, again inflation rate has come down. One of the reason is cited to be base effect. And this particular base effect is not permanent one. What if the prices come back to normal for the month of, let's say, February, March, April, then suddenly you will see a rise in the inflation rate in the coming months. So that is one very important concept that you will have to remember with respect to inflation, and the policy makers will be worried about this. Second very important concern is, yes, inflation rate has come down, but subsequently, right, what has happened is the manufacturers are basically paying higher prices for their raw materials. This has been discussed many times in the last couple of months. The manufacturers, right, such as automobile manufacturers, because of various issues, they are being forced to pay higher prices for their inputs. And when they are forced to pay higher prices for their inputs, what do you think will happen to cost of production? The cost of production will increase. And when cost of production increases, obviously the manufacturer will simply transfer this particular increase in higher market price. That is essentially the market prices of the commodities which are supplied by the manufacturers, it is going to increase. So this is a concern for a simple reason: the demand in the market has not yet reached to normal levels. Is it okay? Understand the logic here. The market prices are set to increase like this. Best example, automobile components, the prices have increased, and majority of the automobile sector players have already increased their market prices. So demand has not yet reached to the normal level. At that particular point of time, if you simply increase the market price like this, don't you think it will have an impact on the recovery of demand? So demand will have a negative effect because of this particular feature as such. That is second very important concern. Third very important concern, the fuel prices. I am pretty sure all of you are watching the news or reading the newspapers related to concept of fuel prices. Now have a look at this. Majority of the freight transportation in case of India is done by using a fuel that is a diesel. And in recent times, what has happened? The fuel prices, that is a petrol as well as diesel prices, have started shooting through the roof. And since majority of the freight transportation, majority of transportation is done using diesel, cost of transportation increases. What do you think will be the impact of this on the market prices? The market prices are expected to increase in the coming days. And when market prices will increase, that will basically lead to again inflationary trends in the market. So these are certain very important points that you need to understand with the concept of inflation. In addition to this, there is another concept which is being discussed in many other newspaper articles, not specifically in this article. That is the idea of a disinflation. That is, understand this. If you see the consumer food price index, okay, consumer food price index, which essentially is a measure of inflation only for food commodities. So if you see the consumer food price index in the month of December, it had increased by around 3.6%. I am just rounding up the numbers. You don't need to mug up all of these particular particulars. This had increased somewhere in the range between 3.4% to 3.6%. And for the month of January, this, the same, that is consumer food price index, has increased by just 1.8%. This basically is referred as a disinflation. So out of all of these particular commodities which are considered, the food prices for these particular commodities, or the prices of food commodities, have experienced a disinflationary trend. Now do not get confused between the term disinflation and deflation. What is the basic idea? In case of a deflation, the price levels will fall. Is it okay? The price levels will fall means what? Imagine, for a basket of commodities, today the price level is 100. Next month or same month next year, the prices have fallen down to 95 rupees. So from 100, it has come down to 95 rupees, which means essentially what has happened? The prices have actually fallen. But when I use the term disinflation, it essentially means there is an inflation rate. Is it okay? There is an inflation rate, but the pace of inflation rate, the rate at which the prices are increasing, that is actually slowing down. I will repeat the statement here, understand this very carefully. In deflation, prices will actually become lesser. Prices will enter into negative territory. Negative rate of inflation is called as a deflation. Whereas in case of disinflation, prices are increasing. but at a slower pace. For example, have a look at this. Consumer Food Price Index for the month of December 3.4 to 3.6%. For the month of January 1.8%. Inflation rate is there, it is positive, but the growth rate or the rate at which inflation is increasing is actually slowing down. This is called as a disinflation. So, this is another very important term which is being discussed in many of the newspaper articles related to inflation for the month of January. So, based on this discussion, I have given a question here. Consider the following statements regarding the base effect in inflation. It is the impact on monthly inflation rate because of the abnormal low or high prices for the same month in the preceding year. Yes, this is a definition of a base effect. It will help in accurate understanding of the inflation rate. No, this particular statement is wrong. Understand this. Rather than providing any accurate picture, if anything the base effect does is basically distort the picture. You will not get accurate understanding. Because in particular month or in a particular month, let's say last year, there could have been many factors which would have affected the supply or the demand for these particular commodities in the market. And the same impact may not be felt in the same month in the coming year or same month in the next year. So, basically what base effect does is it is basically distorting the inflationary trend in the market. So, you will not get an accurate picture, rather you will get a very distorted picture because of the base effect. Okay. So, based on this, option A, only one is the right option. Next, related to GST slab merger, very important article. This could be asked even in the mains also. That is basically if a question is asked, give recommendations for the rationalization of GST or making the GST better, this will be one of the very important recommendations that you will have to make. Now, first and foremost, understand certain concepts here. We introduced the concept of a GST, goods and services tax, which basically took into consideration or subsumed many of these indirect taxes as well as cesses at the central level as well as the state level. What was expected was, first very important point, with introduction of a GST, we will have a revenue neutral taxation structure. Understand the concept very carefully. We will have a revenue neutral taxation structure. What do you mean by revenue neutral? When you are shifting from one taxation regime to another taxation regime, there is a concern, there is a fear that the tax receipts or tax revenues will come down. Is it okay? Right, I will repeat it again. When you are shifting from one taxation regime to another taxation regime, there is a concern that the tax revenues will get affected because of this particular shift. That is a precise reason whenever you come across the concept of a revenue neutrality, it simply means we switched from, let us say, concept of a VAT to GST. Even though we are switching, we wanted to ensure that the revenue that we collect under these particular taxes will not come down with switching from VAT to GST. This was the basic, one of the very central pillars of the GST as such. But what has happened is, once we have introduced GST, we started with the slab rate of 5%, 12%, 18% and 28%. Some books will say 0% is also there, but again that is not specifically a slab, it is basically those particular commodities which will attract 0% GST rate. And some books will say there are certain commodities which will be taxed at let us say 3% such as gold. There is also cesses which are applicable to some of the commodities, luxury products or demerit goods which are under the slab rate of 28% itself. But overall, basically what we say is there are 4 slabs under the GST, 5, 12, 18 and 28. Over a period of time, what has happened is we have started shifting some of the commodities which attracted GST rate of let us say 18%, 28% into lower GST rate. And some of the commodities we have given an exemption to these particular commodities with respect to application of GST. As a result of this, what has happened? Overall GST collection has been affected. Is it okay? Overall GST collection has been affected. So essentially, there is an argument that with introduction of GST, though we wanted to have revenue neutrality, we have not been able to achieve revenue neutrality in the last couple of months or in the last couple of years because of certain exemptions, certain reductions, certain shifting of the commodities from higher tax slab to lower tax slab. Now, what is the issue with this? Issue with this is GST is a very important source of revenue for the central government also as well as the states also. And when there is no revenue neutrality maintained here, it essentially means the revenue collection for both the center as well as the state will have an impact. And since these are very important source of revenue for both of them, their overall revenues will also get affected. So this is one very important point. Now what has been proposed? It's not a very new proposal. Earlier also it was discussed. Specifically, it was discussed by former Finance Minister Mr. Arun Jaitley. What he basically said was we need to rationalize a GST, and even today that is the discussion. How? We need to merge two slabs into one slab, right? That is basically there is a thinking that, or there is a proposal to merge 12% as well as 18%. We need to merge both of them into one slab. As a result of this, what will happen? The 4 slabs will get reduced to 3 slabs. And lower the number of slabs, obviously administration will become much easier. Filing of the returns is also expected to become easier. Collection of revenues is also going to be affected because of this. So we want to rationalize a GST by merging 12% as well as 18%. That is being discussed in this particular article. Now what is the issue with this particular merger? Have a look at this. Like I said earlier also, this particular merger was discussed. What was discussed earlier simply is this. Let's merge 12% and 18%, have a 15% slab, and we will cover all the commodities which are under 12% as well as 18% under this particular 15% slab itself. What is the advantage? Administration will become easier, and under the GST, the basic idea is what? One nation, one indirect tax. And we are moving towards the concept of one indirect tax itself. Again, we are moving towards it. We have not yet achieved it. So that is the objective. It will become much simpler, right, with respect to administration of GST. However, there are certain concerns related to even this particular merger. Again, I am saying 15% was the earlier proposal. Right now, how much will be the actual GST? They have not yet mentioned this. But here is the issue. When you bring 12% or the commodities which are taxed at 12% and commodities which are taxed at 18% under one slab, yes, on one hand, you will be able to collect higher GST revenues because you have increased the GST on some of the commodities. But on the other hand, you will also be losing certain revenues because you have reduced the GST rate from 18% to 15%. And this was a point of concern. On one side, I am going to earn extra. On the other hand, I am going to earn lesser. But what is the net effect? The net effect is the commodities which were taxed at 18% were much higher compared to commodities which were taxed at 12%. In simple terms, what I will be earning extra because of this particular shift is much lesser than what I will be losing because of this particular lower rate or lowering of the GST from 18% to 15%. As per one estimation, they basically said if this is actually done, that is basically 12, 18 merge, have a single rate of GST. If this is actually done, government would be losing a revenue of anywhere around 1 lakh crore rupees annually. And to put things in perspective, 1 lakh crore is the total GST collection of a month as such, right? Generally, you will have a target of more than 1 lakh crore rupees every month under the GST. So this was a concern which has been raised with respect to this particular merger. In addition to this, there is another very important concern. There are very important commodities which are kept at 12%, and if you increase the rate from 12% to 15%, it simply means in the market, those particular the users who are going to consume these kind of goods to produce goods, obviously they will have to pay more taxes, and if they are forced to pay more taxes in the form of GST, their market prices automatically will rise. So how do you account for that? Don't you think it will have a negative impact on the consumption of these particular goods and services in the market? Second, some of the commodities which are taxed at 18%, these will be brought under 15%. Now these particular commodities on which the GST rate will come down, how do we ensure that the manufacturers will transfer the benefit to the consumers in the market again? So these are certain concerns which have been raised with respect to concept of GST slab merger, right? Basically they want to merge 12% as well as 18%. But strictly speaking, understand this, earlier there was one panel, Arvind Subramanian panel. This particular panel basically recommended that we need to rationalize GST and we need to have 3 slab structure. Remember this particular recommendation. we need to have a 3 slab structure. Basically, it was very simple. They said that the goods which are consumed by the common man, let's have a slab structure of a 12%. Those which are demerit goods, let's tax them at 40%. And those particular goods which neither fall under 12% nor under 40%, let's tax them at 17 to 18%. So this was a 3 slab structure which has been recommended by Arvind Subramanian panel. First. Second, very recently submitted 15th Finance Commission report, very, very important. Even the 15th Finance Commission report has recommended that Government of India should have a 3 slab or a 3 tier structure under GST. They are basically saying one should be a standard rate, one should be a demerit rate, and one should be a very low rate. That is basically the demerit goods should attract somewhere in the range of 28 to 30%, and remaining the GST rates should be much lesser, so that there is a rationalization of GST structure in India. And in addition to this, remember one more very important point, there is a need to rationalize GST. Nobody can deny that. There is a need to rationalize GST for a simple reason. One, the states are suffering under the financial head already. Is it okay? Just like central government, states are also suffering. And whenever the GST revenues dwindle like this, right? Yes, especially in the last 1.5 years, the GST revenues collection has not been at the same path as such. In certain months, collection has been very high. In certain months, thanks to pandemic, it has been very low. Whenever this kind of a fluctuation will take place under the ambit of GST, it will have a huge impact on the finance of central government as well as state government. But more importantly, in terms of the state government, rationalization is very important for a simple reason. Come June 2022, that's a very important point or a date you will have to remember. Come June 2022, compensation which is paid to the states will be discontinued. What is this idea? When GST was introduced, some of the states raised a concern that with change or with the shift to the GST as such, the revenue collection of the states might get affected. Earlier, the states had the power to impose certain types of state taxes and collect the revenue that they actually required. But when it is shifted to the concept of a GST, when these indirect taxes will be subsumed under the GST, states alone cannot decide the tax rates with respect to these types of taxes. So to protect the interest of the states, the government said we will provide 100% compensation for a period of 5 years. And this particular tenure or period of 5 years will be over in June 2022. And after this, any lower collection of a GST revenues, the central government will not be providing any kind of a compensation to the states. So states want the stabilization in the GST as soon as possible, because after June 2022, they are on their own. So these are certain very important points related to concept of a GST slab merger. Now based on this discussion, I have given a question here. Consider the following statements regarding the base, just make a correction. This is the repeated question here. Okay, base effect, we have already taken care of this. Next article, 5 job surveys. Okay, very important. In case of India, unemployment has been one of the very important issues. To understand this, generally Government of India earlier used to measure employment as well as unemployment once every 5 years. Is it okay? They used to conduct surveys and measure the employment as well as unemployment for a period of 5 years. That was referred to as employment unemployment surveys. But there were certain issues with this. We have discontinued this particular concept and we have replaced this with PLFS, periodic labor force surveys. Remember this, we have replaced or we have discontinued concept of employment unemployment surveys and we have introduced the concept of a PLFS, periodic labor force surveys, which is done for a period. Annually it is conducted, and quarterly data is also available under the concept of a PLFS. Now there are certain issues with respect to unemployment which have crept up in the recent days. For example, because of the pandemic, there was a migrant crisis in India, and that basically threw up a concept of a informal economy or issues related to informal sector in India, issues related to the jobs in the informal sector, unorganized sector. The migrant labor crisis also crept up. So in order to address all of these particular issues, Government of India now has proposed 5 job surveys. That is basically 5 different surveys will be conducted, data will be collected to have a better understanding related to job sector in India. Now, which are the 5 areas or different 5 surveys which will be conducted? Remember this, the surveys will be done in industrial establishments, professionals, migrants, domestic workers as well as the transport sector. So, these are the 5 areas where the surveys will be conducted. Now, why it is very important? First and foremost, understand this, whenever there is a discussion on the concept of employment and unemployment, we do not go for a census. We do not go for a census, we rather go for a survey. Very difficult to conduct census, because under census we have to collect the data from every input point, that is every household the data must be collected. But under the concept of a surveys, especially for let us say estimation of poverty in India, estimation of employment, unemployment in India, what we go for is the concept of a sampling. In simple terms, let us assume, let us take a very simple idea here. Those particular students who are from the stats background will understand this much better way. Imagine we want to collect or we want to find the data for let us say 1000 households. Okay, we want to find the data for or have a survey for all the 1000 households, but very difficult to collect the data from all the 1000 households. So, what we do is we will simply choose samples. We will choose let us say 100 households, just a hypothetical idea, and we will collect the data from all the 100 households. Then we will calculate, expand the data to apply it for all the 1000 households. This is a basic idea for sampling survey. Now, what is the importance of this particular idea in the present situation? The 5 job surveys which are proposed by the government will have very large samples. It will consist of large samples. What is the importance? Higher the sample, better representation of the overall picture here. So, the large samples will be taken under this particular 5 job surveys, first point. Second very important point, this particular survey or 5 job surveys will take somewhere around 8 months and the data will be published after this particular time period. But this particular data will be used for better formulation of policies or schemes by Government of India. For example, social welfare schemes. Third very important point, Government of India has stated that using this particular data, we will try to convert the informal units or informal sector in India into formal sectors. The basic idea here is, whenever you discuss the concept of informal sector, it is associated with no job guarantees, no fixed wages as such, right, no hidden benefits to the employees, so on and so forth. Whereas all of them are present in case of the formal sectors, right. So, we want to convert informal sectors into formal sectors. And fourth very important point, it will even cover the gig workers. It will even cover the gig workers, and the data will be collected and the policies will be formulated to protect the interests of these kind of labor units as such. So, these are certain very important points with respect to these particular 5 job surveys. Next point, concept of a P note. Now, what is this idea of a P note? Understand the concepts here very carefully. Much of information which is given in the article is not important, but what is important is the concept of a P note, very important for UPSC prelims. Generally, if a foreign institutional investor wishes to invest in the stock market in India, is it okay? Whenever a foreign institutional investor wishes to invest in Indian stock market, he has to be registered under SEBI. He has to follow the KYC norms. He has to provide all the relevant data which has been sought by SEBI, market regulator here. But there are certain investors who wish to invest in Indian stock market. They want to invest in Indian stock market, but they do not want to be registered and come under the KYC norms of SEBI. So, what these investors specifically do is, they will approach these particular foreign institutional investors, provide them money or basically hand over their investments, and on the behalf of these investors, these FIIs will invest in the Indian stock market. Is it okay? Investors will give their investment to FII, FII will invest this money in the Indian stock market. And since these particular investors are not registered with SEBI, who are these investors whose investment is coming into the stock market? That information is not available. Is it okay? Now, when these investors have handed over their money to FII, FII in return will provide a certain security. Is it okay? that is nothing but instrument. So have a look at this. FII, imagine I am the FII, you are the foreign investor, you have given me 100 crore rupees, just a hypothetical situation. You have given 100 crore rupees to me and I have taken this 100 crore, invested in the Indian stock market. And since I have collected 100 crores, I will have to give certain receipt to you, I will have to hand over certain instrument to you. So this instrument which will be issued by FII to the investor like this is called as participatory note. P note in short, participatory note in the long form as such. And these particular participatory notes are being used worldwide in many of these particular stock markets. India is not an exception here. Now what is being discussed in the article? Over a period of time, there have been certain concerns which have been raised with respect to P notes generally. For example, since these are issued for these particular investors who are out of India, foreign investors, SEBI does not have any information related to who are these particular investors, right? It does not get access to the information related to these particular investors. That is one problem. Second very important problem is, there is a concern that this could be used for money laundering process. What is the basic idea for money laundering? Money laundering, look at the term laundering there. Laundering means cleaning up. So black money could be converted or could be made white money using these particular P notes. Again, there is a process which is used, not important here. So there is a concern that this particular P notes route can be used for money laundering process. Third very important concern, these particular P notes could be used for price rigging of the stocks in India. What do you mean by this? Imagine I am one of the promoters in a particular company and this particular company is listed in the stock market. I have got lot of black money, I will route it into the P notes back into India. I will ask the FII to keep on purchasing shares of the company in which I am the promoter. And since this particular FII is infusing lot of money, purchasing lot of shares of my own company, what will happen to market prices of this particular share? Market prices will start increasing. This in simple terms is nothing but a price rigging. So there is a concern that the P notes could be used for price rigging in the domestic market, in the stock market. So against this, SEBI over a period of time has taken certain regulatory measures, but again this particular article says that in the recent times, how much P notes are flowing into India in terms of value, the value is increasing. For example, in the month of December, the overall investment under P notes was to the tune of around 87,000 crore rupees, which is a 31 month high as such. And not only this, a huge amount of investment has actually flown into India under the concept of FPI itself. That is, under FPI route, over $35 billion has flown into India, which is the highest even in case of India and which is the highest amongst all of these particular developing countries. But the SEBI chairman basically says there is no need for concern about these particular P notes. We have regulatory process in place. So this is basically the discussion related to this particular article. Next, fuels under GST. Now what is discussed in the article? First and foremost, there is a discussion related to natural gas. Please be very careful with respect to this. Understand this, as of now, the hydrocarbons such as natural gas, aviation turbine fuel, petrol, diesel, crude oil, these do not have a GST rate. That is, as of now, no GST rate has been notified on these particular commodities. It is up to GST Council when they want to bring these particular commodities under the GST rate slab as such. So with respect to natural gas, what is the issue here? In case of natural gas, every state has a different taxation rate. Is it okay? Every state has a different tax rate on the natural gas. So various experts basically say, whenever natural gas is traded or sold in the Indian market, since different states have different rates of taxation, it is like saying there is a trading or there is a selling of natural gas in 29 different markets, because different state, different rate, and different taxation rate, different market price. So it is as good as saying there is 29 different markets for natural gas in India. So what can be done with respect to this? Understand this, right now in the energy basket, the contribution or basically the proportion of consumption from natural gas is somewhere in the range of 6 to 7%. It accounts for around 6 to 7% of the total energy basket. Government of India wants to increase this to 15% in the coming years. In order to promote the consumption of more and more natural gas, we need to first ensure that the prices of natural gas will be stabilized in the domestic market and will be much lower compared to what it is right now. So, one of the proposal which is being floated by Government of India, which Prime Minister basically pointed out, is that they want to bring natural gas under the ambit of GST. Is it okay? This is one point which is discussed in the article. Now, second point is with respect to petrol and diesel prices. Now, if I want to tell you in gist, simply understand this. Right now, the petrol and diesel prices in the market are very high for a simple reason. One, international crude oil prices have started increasing, and second, the taxes which are imposed by central government as well as state government on both the petrol and diesel are higher. One data has been given with respect to the prices of petrol in one of the cities. Out of a price of, let us say, 89 rupees, which is the market price or retail price of the petrol, more than 60% of this particular price is because of the taxes imposed by the central as well as the state government. Now, what is the recommendation? Basically, the article says if you want to reduce the prices of all of these particular commodities, make the market prices much more rational, you will have to bring even this particular petrol as well as diesel under the ambit of GST. But here comes the problem. Generally, the fuel commodities, understand this very carefully, generally the fuel commodities will have an inelastic demand. This is a technical term. What do you mean by inelastic demand? Whenever the prices will change like this, the consumption will change by a very small margin. Is it okay? The prices will change by much higher margin, but the consumption might be affected by a very small margin. That is the reason these are called as inelastic demand. For example, yes, the prices of petrol as well as diesel have shot through the roof. Does it mean that we have stopped consuming petrol and diesel? Does it mean we have cut down our consumption by 50%? Absolutely no. Consumption will continue because these are essential commodities for us. But here comes a problem. When these will have an inelastic demand, these are also very important source of revenue for governments. Not just the central government, even for the state government. Since these commodities will have inelastic demand, even if government increase the tax rate on this, we will continue to consume these particular commodities. And since we continue to consume these particular commodities, because of a higher tax, governments, central as well as state, will be able to collect higher tax revenues. So, these are certain points related to concept of relieving the fuel burden by placing these particular commodities under the ambit of GST. Based on this, I have given a question here. Consider following statements regarding, again the repeated question, do not worry about this. New foreign trade policy. Okay, next question is related to new foreign trade policy. Now, understand this, the earlier foreign trade policy was supposed to end in 2020. So, we wanted to introduce a new foreign trade policy for a period of 5 years. But because of the pandemic, what we have done, we have shifted the time period and we want to announce a new foreign policy on 1st April 2021 now. And one of the points is being discussed which is supposed to be done likely under this particular new foreign trade policy. What is the idea? The new foreign trade policy is likely to push the digital methods. That is, basically it says the government of India might simply ask these particular companies in India to use e-commerce companies to increase their sales across border. Is it okay? They want to push the sales of these particular companies not only in Indian market but also increase this across the border so that they can increase their sales outside India, generate revenue within India. So, these are very important so that they can produce more goods in India, increase exports also, and also generate lot of revenue for the domestic companies, which will help the government of India in pushing the idea of a Atmanirbhar Bharat. First very important point. Second very important point, concept of a CBEC zones. What is the idea of a CBEC zones? Basically, idea of a CBEC zone stands for cross-border e-commerce zones. That is, understand this, the production happens in India, but this particular commodity using the e-commerce website is sold across the border. In order to promote this, the article basically says Government of India needs to promote concept of a CBEC zone, which will basically a notified area which will consist of all the stakeholders in this concept of a e-commerce segment as such. So, this is another very important point. Third very important point, one district, one product. ODOP. Remember this particular term, one district, one product. What is the idea for one district, one product? We are going to identify one district and we are going to see the potential of the district in terms of a manufacturing of a product and its export potential. Understand this. What is the potential of manufacturing of this particular product, and does this particular product have any export potential in the international market? Many of the states have already started implementing the concept of one district, one product. For example, Uttar Pradesh has already implemented concept of a one district, one product. So it is said that the new foreign trade policy, 5-year foreign trade policy is expected to push the idea of a one district, one product. So these are certain very important points which are discussed in this particular article. The last article for the day related to one of the interviews which was given by Mr. N.K. Singh, who is the chairman of the 15th Finance Commission. What he has basically said is, very recently the central government has come clean with respect to its fiscal deficit. Earlier there was a lot of issues with respect to the fiscal deficit data which is quoted by the central government. And in the recently concluded budget, central government basically said the fiscal deficit has been revised to 9.5%, which essentially means there is more clarity with respect to fiscal deficit data for Government of India. So the Finance Commission chairman basically says the same should be promoted by the central government even at the state level. The state governments should come out with a better fiscal deficit or more clarity with respect to their fiscal deficit numbers. First point. Second very important point, central government has basically come out with a new public sector policy. Okay, basically under this they have identified the public sector enterprises into the strategic as well as non-strategic, and they want to disinvest or completely sell off the PSCs, CPSCs under the non-strategic sectors. The same has been recommended by this particular chairman. What he says is, central government must incentivize states, just like center will go for disinvestment, these particular states will be able to generate a lot of revenues which will help in stabilizing their fiscal position. And second very important point with respect to this, when even the state governments will come clean with respect to fiscal deficit number, consider all the types of off-budget borrowing, so on and so forth, and have a better picture of fiscal deficit just like the central government, it will increase the investor confidence in the market. So these are certain very important points discussed in this particular article. Now, these are the important articles for this particular time period. So that's it for the live discussion. If you like the initiative, please hit the like button. If you are not at the subscribe of BYJU'S IAS, please subscribe to our channel. Thank you. Have a good day.